Well, for more on housing and AI trade troubles, let's go ahead and bring in our next guest. Is Peter Boockvar. He's CIO at Bleakley Financial. Peter's also a CNBC contributor. Peter, thanks so much for joining us. I know you've probably been listening to some of this conversation. What do you make of what you heard today from TSMC when it comes to what's going on in the chip space, the broader situation and hype about AI? We're all excited about it, but it's still such a small part of the business, albeit there's a lot of room for innovation and growth down the pike.
Well, that's one thing that the hype of AI and excitement of it did in Q2. It made people forget about what was going on in Q1, and that's what was a slowdown in chip sales to PCs and to smartphones. And even if you look at these big cap tech companies, they all grew single digits. But again, the AI craze, the hope that the Fed is done raising interest rates, sort of whitewashed Q1 and allowed these hopes and dreams to develop in Q2. And earnings now is sort of a reality/gut check for what's going on the ground. Most semis go into PCs and smartphones, and those end markets are still contracting. AI is very exciting. NVIDIA is obviously a huge beneficiary of that, but there's a huge chunk of the semi business that is not selling into AI. With respect to D.H. Horton, one of the old rules of thumb when it comes to trading home builders is you buy them on 1x book or less, and you sell them at 2x book. Well, D.H. Horton happens to be trading at 2x book. And you just have to wonder, how sustainable is the housing strength when mortgage rates are at 7%? It's been good so far, but I think investors are just wondering for how much longer.
Yeah, and to that point, I understand that when you're looking at the housing market, you just look at it and think it's a little bizarre, the fundamentals that we have going on here right now.
For sure, when you have existing home sales that outside of COVID are near the lowest level since 2011. So it's a rather bizarre housing market, but affordability is still the overriding issue, both in terms of the price of a home rising 40% over the past couple of years and a doubling of mortgage rates. Now, home builders have been able to take advantage by buying down mortgage rates, by creating teaser rates. But again, the housing market needs that first-time buyer. And that first-time buyer right now is very strained from an affordability standpoint, raising those sustainability questions with new builds.
It's Karen. Let me ask you something. Do you think then, how do we see an equilibrium then? And I understand, obviously, prices of homes are higher, and there's this odd existing home versus new homes. But it's been a while now that rates have been higher for mortgages. How do you think this stabilizes or plays out?
I think you need a decline in mortgage rates, or you need a decline in home prices. You need one or the other to make home buying more affordable. Within the existing home sale number, first-time buyers made up 27% of purchases. The record low is 26. Unless you get that first-time buyer, you sort of clog up the housing industry. And I think you need to see some alleviation on the affordability side, whether on the rate side or the price side. And right now, we're not seeing really any give on either.
Hey, Pete, so we're probably, 20% through S&P 500 earnings right here. We saw some big reactions today, both, up and down. And I'm just curious to get a sense of what you thought of the move in TSM and Netflix that ran into their quarters. But then there's a Johnson & Johnson on the other side that's been pretty weak, that had a great day after, having a better than expected quarter. I'm just curious, early readings as far as what you're thinking as far as earnings season and how it's shaping up.
Well, I think positioning is huge here, and we know we've created a very high bar for a lot of companies to leap over when it comes to earnings. But I think, again, we're getting a reminder that overall, it's still a challenging macroeconomic environment. And that's not coming from me. It's coming from the companies. I heard that throughout Q1 earnings calls, and I'm hearing it in many Q2 earnings calls. And when you have a run in the stock market that is solely based on PE multiples, well, eventually you need the E part to substantiate the P part. And we're just not seeing that yet as earnings continue to decelerate. I mean, coming out of the first quarter, earnings estimate for the S&P were closer to 220. Now they're under 217. Interest rates are remaining very sticky at high levels. And you have, obviously, a move higher in the multiple. So I think that the challenges here for the next couple of weeks as we digest more earnings, it's going to be tough to exceed these expectations. I mean, you get bizarre behavior. I mean, look at Taiwan Semi opened up down 5%, and Apple, one of their biggest customers, opened up in the morning. Obviously, it closed down, but I think there's some issues that need to be reconciled, let's say, over the next couple of weeks when we get earnings. Is again, that's the reality check for the market that has been somewhat forgotten over the past 3 months since Q1 earnings were reported.